How to get rich in the second half of 2022 after experiencing one of the worst stock market and bond market crashes in history to start off the year. Here's how we recommend investing every $10,000. Essentially, the exact opposite of what's happened in the last 6 months we're predicting is going to play out to close out the year. This is our trade alert table for a $10,000 position. And if you want to do more, you would just double for 20, triple for 30, etc. So on the defensive side of the portfolio, we have two plays. We have the VIX with ticker UVXY, 90 shares. This is a 12.8% allocation right now. And if the S&P 500 goes down violently, the UVXY goes up sharply. And I'll show you a chart of that during the March 2020 crash. The deflation play, which can go up if interest rates fall, which could be for good or bad reasons, is TMF. So TMF could go up with stocks, or it could go up if stocks go down. This is the single safest place to put money right now after experiencing a 2-year bear market. This is 3 times the long end of the US bond market, currently coming in at 25% of the portfolio with 191 shares, ticker TMF. On the offensive side, we're looking for the ultimate growth play in Ethereum with the Grayscale Trust ETHE, 281 shares coming in at 21% of the portfolio. We're triple leveraged in the gigantic tech stocks with FNGU. It's 12 of the biggest tech companies that have complete monopolies in their industry with 135 shares. And then we've still got to be worried about this darn war and governments that seem to be trying to make the cost of energy go up, with the reasoning being democracy or climate change, which is a bunch of hogwash, but better be ready for it. We have 5 shares of the large US oil and gas companies, leverage times 3, ticker NRGU. And then we're long natural gas with 33 shares of Boyle. Now, right now, there's a delay of getting the LNG from North America to Europe. And the disparity in natural gas prices is almost tenfold. And this is due to some hurricanes that are delaying the ability to get this exported. So massive opportunity for a short play as the war marches on and both sides seem stubborn to come to a ceasefire. Now, I do think we will see a ceasefire well before winter. So we'll most likely be taking profits of NRGU and Boyle before these other plays. Let's break down each play one by one. Step 1, buy 90 shares of UVXY, the deflation insurance hedge. And again, this is the stock market crash hedge. This is March of 2020. You can see when the S&P 500 fell 25% in a month. It shocked the markets, and the VIX with ticker UVXY went up as much as 1,000%. So if you had 10% of your portfolio in UVXY in this horrific decline in the market, you actually didn't lose a penny. So it's a really great way to insure your portfolio. Now, this is a chart of all the times the Federal Reserve's gone too hard with rate hikes. And it's almost always ended up with deleveraging stock market crashes. Now, I do want to point out there's been plenty of times where they've reversed course and prevented markets. And that's actually what I'm anticipating will happen. But if the Federal Reserve is really going to keep hiking interest rates into a massive slowdown in the global economy, they're almost certainly going to cause a lot of pain in markets. My base case is they're going to become pivoting dovish into midterms. But if they don't, we want to have this crash insurance policy. And if we look at the big picture of the Dow Jones, and we look at some of the crashes and recovery times in history, we do need to realize that there is severe risk to the downside if policymakers can't get control of inflation. Now, I'm going to give you a great argument that inflation is already dying down and that most likely we're going to see assets rocket up for the remainder of the year. But this chart does give you some perspective, especially in the Great Depression which ended up taking 25 years to recover. And then the inflation in the Johnson, Nixon, Carter era, which took 16 years to recover. Step 2, buy 191 shares of TMF. That's the bet that interest rates will go lower. Here's the chart of TMF. It's leveraged on the 20-year treasury. And again, we don't care about anything except that the global economy is slowing down, inflation is falling. This means interest rates are going to fall. So its recent high was up in the 50s, and we can pick it up at 1260 today. This is the US core inflation rate. This is not including some of the stickiest inflation data like food and energy, but the core inflation rate's been falling for 3 months. Now we have food and energy starting to fall rapidly, especially in the last 48 hours. So most likely all inflation data is going to start printing negative month over month. And this will give us that critical pivot we need from the Fed to slow down rate hikes. Now, TMF is just the leveraged version of the TLT. Here's another look at the bond market. And it's really simple. For governments to grow debt over time, they must drive interest rates lower or the whole system collapses. And with the promises of the US government to its people, it's essentially trillions and trillions of dollars insolvent. So they're going to have to borrow lots of money. It's going to grow every single year for the rest of our lifetime. And they're currently trying to figure out how to drive interest rates into negative territory like we've already seen in Europe. There's only a few bond markets that are still upset, and all the pain we've seen in the market in the last 6 months has been due to interest rates rising. So this is one of the few that's still rising. The US 3-month has gone parabolic and is up 1,876% year to date. And this is actually one of the few bonds we can still see rising. Here's the 2-year. This is essentially what dictates what the Federal Reserve will do. And until about a few months ago, it was rising. Now, just about a month in the past, it was at 3.4, which was expecting to be the new terminal rate for the federal funds rate. But over the last several weeks, it's already fallen down to 2.88. So this is going to give the Fed a lot of relief pressure on how far they need to hike interest rates. And it also makes it a lot easier for the stock market to support its current valuations. Same pattern in the US 10-year. And you can see since the great bubble in the bond market burst in the 70s, we've been on a 40-year decline in interest rates. And if the government wants to keep borrowing money, they must drive these rates lower once again. And again, if we look at the current chart, we can see the 10-year has finally cooled off and is starting to stabilize and fall. Over in Europe, the bond market that's been the least happy is the Italian 30-year. The spread between the Italian and German bond market's been creating all kinds of havoc. And so now the ECB is going to use maturing German debt to pay off Italian debt. Quite comical. But the same pattern is finally starting to emerge in the one of the most upset bond markets in the world, the Italian long bond. And you can see it's starting to fall. So in general, what we're seeing is the bond market crash appears to be over and recovering. It's time to go long risk assets. Here's a look at the German bond, same pattern and the same recovery underway. Japan has been implementing yield curve control. And lots of big money has been simultaneously shorting their currency and bond market, betting that they can't protect both at the same time. And so Japan's been spending upwards of $80 billion a month to buy an unlimited amount of its bonds, especially on the short end, to prevent rising rates. Now, what's about to happen as global bond markets cool off and inflation begins to fall, there's going to be an epic short squeeze on both the currency and the Japanese bond market, which is going to drive interest rates much, much lower. And again, force money into risk assets. And we can see here with the Japanese long bond, it's also now beginning to cool off. Probably the most concerning bond market outside of the 3-month treasury is the US high yield junk bond market. And this is the one that we need to keep a close eye on. If we do zoom in, it is starting to finally cool off, but this has been leading the S&P 500. So we're keeping a very close eye on that, but it's also starting to recover. The investment grade bond market's already recovering sooner than the high yield market. And you can see all these bond markets are at critical historical technical levels. If we look at the core PCE price index, it's starting to turn over. If we look at PMIs globally, they've all been falling off a cliff. Now, China's PMI is back to 55 after dipping as low as 35. It looks like they did that just to cool off the inflation for as long as it needed to before restarting their economy. If we look at cocoa, cotton, orange juice, coffee, lumber, or sugar, all of these key commodities are falling rapidly in price, signaling peak inflation is now behind us. The used car index, which was leading the inflation, has been crashing for several months now, going negative. Container shipping rates are now falling rapidly. So essentially, the bond market now does not believe the dot plots of the Fed anymore. So most likely the Fed will pivot here as we lead into midterms. And the stock market and cryptocurrency market is going to really like this. Soybeans falling off a cliff, falling from 1755 down to 1316. Wheat falling from 1250 down to 807. Corn falling from 820 to 578. Copper falling from 5 down to 3.35. The Dr. Copper, every little piece of data we have outside of oil had been falling for several months now. Lumber futures have been predicting this crash in oil months in advance, just like it did last summer. Baltic Dry Index falling from 5,000 down to 2,098. That's the cost of shipping commodities between continents. So essentially, we're seeing every bond market, except for the high yield, starting to fall here. This can be very good for markets. We're also starting to see a cool off in housing market, especially in some of the hottest parts of the real estate sector. Okay, so that's why you should buy treasuries. We can clearly see there's a major global slowdown occurring right now that will drive interest rates lower. Next step is to buy 281 shares of the ultimate growth product, Ethereum. So Ethereum's doing two things. One, it's something like Windows, but for decentralized applications. And then two, what it's really doing is it's replacing the financial system. So that's where it's really seen the best growth, is replicating a lot of the products in the US financial banking system into DeFi. Now, this topped off well above 4,000, currently trading at 1134. This is a great time to get long Ethereum. Here's the 1 year chart, or the year to date chart, down 64%. The last month was the worst month for cryptocurrency in its history. The Bitcoin 200-week moving average has only gone negative 4 times in history and has been a killer buy signal for crypto. RSI reading is also at a historically low level, signaling to buy. And we can see it actually went further, but it was the worst month ever for Bitcoin last month. When there's blood on the streets, you want to buy the dip. Future projection for Bitcoin goes sky high. The governments are not going to stop growing debt. And we have the DXY trading today at an insane 107. We're projecting, as the markets cool off, that we're going to see DXY fall from 107 to 90. And that's quite likely going to send Bitcoin up towards $300,000 this cycle. And this cycle will most likely last 2 to 4 years. So there's your Q2 return, negative 56% for Bitcoin, the worst in its history since 2012. The only time that was similar was 2018 with a 50% decline. And it was a beautiful time to buy the dip. Now, why do we go long cryptocurrencies? It's because of the growth of debt. And we can see the US took 215 years to reach 7 trillion in debt. And since March of 2020, it has doubled that. So the acceleration of debt is is not slowing down. It is compounding at a faster and faster pace. Now, this is what is really holding back the price of cryptocurrencies right now, is the DXY index is going straight up. Most of the best returns in crypto have been with DXY falling. So as the war comes to a resolution and energy costs come down, bond markets heal. Expect for the dollar to fall and for cryptocurrencies to finally get that bid after the 6-month bear market. And here's a look at DXY through its history. It's in a clear downtrend. It's been losing its power, but it does have these periods where it goes up parabolically. But what happens after that is it falls sharply. And you really want to be long Ethereum when it starts to fall rapidly. Now, for this to happen, we need some of its competing currencies to stop crashing so hard. So the USD yen is down 17%. So the Japanese have lost 17% of their buying power as they've protected their bond market. But once again, soon as the inflation slows down, everybody shorting the Japanese yen and bond market are going to get caught off guard and short squeeze. This can be very beneficial to the US stock market and cryptocurrencies. Same thing's happening with the Chinese yuan as they're trying to protect their real estate sector and hit the target 5.5% GDP. It's going to be very difficult because they locked down their country for much of the year. Meanwhile, the euro is now at parity with the dollar, which is remarkable. And so they've got a lot of problems in Europe. This is the main currency pair against the dollar and the DXY index. But the same setup's happening globally as soon as we get the US Federal Reserve to pivot dovishly. Next step is, in the short term, we still got the risk of a shock to energy markets due to the war. We recommend 135 shares of this is our tech play. The next play will be our energy hedge. Similar to Ethereum are the tech stocks. In fact, they're extremely correlated. This helps diversify the same investment expression. 135 shares of FNGU leverage times 3 gives you exposure to 12 of the largest tech giants, including 2 out of China, which have been selling off for more than a year. If we look at the chart of FNGU, it topped off above 40, currently trading at 830. Some of the companies that are remarkable in this index are Amazon, which is down impressively at a critical support level, which it does seem to be trading sideways and getting ready for a new move higher. Apple, same thing. Buffett's not selling his Apple. It's beginning to stabilize. Tesla, same pattern, starting to stabilize. And then Alibaba, which has been selling off for over a year and now is starting to outperform a lot of its tech peers. Now, unlike the Nifty 50 valuations, the tech stocks today make lots of money and they are not overvalued. So with this big sell-off, this is a great time to gain exposure to the big monopolistic tech companies around the world. This chart's just looking at the 12-month return after market troughs ended during recessions, and the average return over 12 months is 43%. So we may not be at the very bottom of this sell-off. I think we are, but either way, 12 months out from today is a very positive return. If we look at forward PE multiples, we're at the 16 times earnings. And as long as that 2-year keeps falling, these are appropriate PE levels. The lowest we've seen is 14 times, and that happened twice in the last decade. Insiders in tech companies are rapidly buying up shares. This is typically predicted bottoms. And if we look at some of the major indexes, we can see we're still at elevated levels, but we've sold off viciously for 6 months. Here's the NASDAQ, same pattern. Emerging markets, same pattern. And in Europe, still actually holding up quite well considering everything that they've gone through. Now, to predict a true recession, we would really want to see a steepening of the yield curve. We're still at the process where it's inverting. all of the major recessions we've lived through had a steepening of the 2 and 10-year treasury, and that's just not happening yet. If we look at the labor market, the jobs keep pouring on. There's 2 jobs for every potential worker. Banks keep growing credit. Consumers keep growing credit. Retail sales, while slowing down, is still at all-time highs. And the US consumer keeps importing massive amounts of goods. So we're just nowhere near some sort of massive recession or depression. In fact, new home sales, even with these skyrocketing interest rates, still came in at 696,000 new homes sold. Now, China did lock down and sent their PMI nearly to 35. If it had stayed at that level, we might be more concerned. But now that they've rebooted, the PMIs jumped back to 55. So it looks like they've done just enough to slow down the inflation, but keep the economy rolling along. If we look at Chinese exports, they're popping right back up to extremely high levels, and their imports are coming right back up to the extremely high levels we've seen over the last year. So we're not predicting a recession or a big stock crash from here. Buy the dip. Step 5, buy 5 shares of NRGU to protect against the war. Here's where we're at with the Ukrainian-Russian war. And right now, Russia's taken over 75% of Ukraine's economy with the red territory they've currently conquered and control. So it's unclear how far Putin will go and how much pain Ukraine wants to suffer, especially the rest of Europe, as this is causing their electricity costs to go parabolic. We now have people protesting all through Europe and big problems. I believe that sooner than later, there will at least be a short-term ceasefire in the war. If this carries on through winter, Russia's going to really have the upper arm by being able to shut off natural gas to Europe, and it'll be lights out. Now, insiders in the energy index have been selling shares rapidly, predicting the sell-off in oil. But now it's been greatly overdone, and Warren Buffett just picked up $55 million worth of Occidental. So he's buying the dip all year through this crash and really loading up on energy companies. Now, oil has fallen from 134 to 99 and is likely going to trade sideways here. I'm not expecting it to go much lower. And as long as it's in this level, energy companies in the US should be making lots of profit. So we like to be long NRGU until the war ends. Now, once the war comes to a pause, I do expect oil to fall much further. So we'll be careful to sell that as we get closer to this moment in time. One of the big players in NRGU is Exxon. So here's a little look at their chart, trading at 81. That's cheap if oil is going to be at $100. And here's a look at its chart, trading as high as 100, falling to 81. I believe it's going to go right back up here as long as this war continues. Now, there's talk of capping Russian oil at $50 a barrel. There's no way the Russians will sell their oil for that price. And it's unlikely the buyers of Russian oil, which are now China and India, would follow the NATO alliance into to those sanctions. But if they did, the likely outcome is that oil would skyrocket upwards of 300 if Russia just simply shut off all of its oil exports for a very short period of time. Here's a trend line for commodities. We're at a very critical trend line. And again, I believe this is a very good buy the dip opportunity for just about everything in the portfolio. There's really no signs of a crash in the economy. We still have people quitting jobs at rapid pace, and we still have the labor market growing significantly every single month. In fact, we still have a high turnover rate because people are flopping from one job to the next to see who will pay them the most. The step 6 is to get another war hedge with BOIL. This is a natural gas play. If we get a hot summer or a cold winter, the demand for natural gas is going to go right back up. So historically, we've seen this trade in the $2 to $3 range. But since this war broke out, it's been trading in the $4 to $8 range, currently at 550. This is a great time to get long natural gas, again, until there's a resolution in the war. Here's a look at the Germans' electricity. This chart alone will tell you why there's going to be a lot of political pressure to end this war sooner than later. So we don't want to be long energy beyond the war. And you can see it's gone from 50 kilowatt per hour to 300. And now they're firing up coal plants and abandoning all of this climate change agenda that was so pressing. Here's an interesting photo. In the Netherlands, the farmers were being told they're not allowed to farm anymore as the government's trying to essentially kick them off their land and build houses for immigrants, apparently, or to keep nitrogen use lower to help drive natural gas prices lower. Either way, people are pissed and the pressure is building to make changes and get the cost of living down. Okay, so this is where your video ends if you're on a free trial and not a paid member. There's 3 spots a day at special pricing. Call Dean at 505-322-7515 to upgrade and gain access to our membership area, where you can punch in exactly how much money you have to invest, and it'll tell you exactly how many shares to purchase.